So I'm not used to talking to slides. This kind of feels like a bit of a high school presentation. So if you want to ask questions as I'm talking, you're more than welcome to. But I am the Chief Investment Officer of Viola Private Wealth. So we're a high net worth, ultra high net worth private client business. And the Australian wealth management landscape has gone through massive transformation in the last 5 to 10 years. If we think about the types of businesses like ours, 5 to 10, 15 years ago, our service to clients was stop being at telling you whether to buy BHB over Rio or, CBA over NAB. There's been an enormous democratization of private markets. And in particular, in Australia in the last, I would say, 2 to 3 years, there's been a huge amount of access into markets that was once only reserved for the largest pension funds, endowments and institutions in the world. And so a huge part of the reason why clients come to us is access to private markets, because quite often, not always, but quite often, that's where the most attractive opportunities are found. But I always like to define what is an alternative investment. I was just speaking at an event with Federated Premiers, and it was an extremely sophisticated room, CIOs, head of alternative investments. But I always like to set the stage because it still confuses everyone, right? So there are only two types of asset classes. There are traditional markets, which are long-only equities, fixed income, cash, and then there are alternative investments. And so at Viola, we have 5 clearly defined subcategories. The first is private equity, venture capital, obviously the topic of discussion today, private debt, private credit, property and infrastructure. A lot of people don't put property in the alts bucket. It deserves a place in the alts bucket. The Future Fund actually incorrectly defines property as a traditional asset class. Hedge funds, and then we've got a category we call zero beta alternatives, which is for everything that's a little more esoteric, like litigation, lending, water rights, music royalties, things that don't fit neatly into any of the other categories. And so when we are building portfolios, and we'll go through a little bit later about exactly how much we do, it's about 40% on average for most clients into private markets. And we're a leader in this space, and we're kind of well known for our alternatives allocation. We're not only thinking about the benefits of alternatives and the diversification and correlation benefits to public markets like the S&P 500 or the MSCI World. We're thinking about how we're building these individual sub-sleeves and how they interact together. And so we do particular things in private equity. We do particular things in venture capital, and I'm not expecting them to behave in the same way. I have high return expectations of venture capital, but we also need more patient capital, right? And not all of our clients have the tolerance or ability to lock money out for 10 or 15 years to get those 6 or 7x returns. Daniel, what was the name of that fund, by the way? You were... Go. Okay. So we actually had our own proprietary asset allocation model that we invented called the core squared satellite model. So you would have heard about the core satellite model, where you got typically a passive core and then you've got satellite investments around that. In line with the evolution of technology and access to private markets, we believe that client portfolios deserve 2 cores, a traditional asset class core and then an alternative investment core. So you could say the traditional asset class core here, about 60% is still going into public markets. Businesses like NVIDIA still live there, and they're still fantastic businesses to own and buy. But we believe that your alternative investment sleeve, which is typically about 40%, should be broken down into semi-liquid evergreen funds, which is the core, and then satellite alternatives, which is absolutely where venture capital should live, right? And there are a few reasons why we break these down. Number one is liquidity, right? So quite often, our clients are coming to us after they've sold a business. And in Australia, there's a lot of non-tech generated wealth. It's not all tech founders and entrepreneurs in Australia. It's sometimes a good old-fashioned widget factory in Western Sydney. I once, built a portfolio for a client who literally sold an orange farm, and they had $40 million in their account, which was $39.9 million more than they'd ever had before. And that client really needs advice, right? Because they don't want you to fuck it up. They don't want you to lose the money, because it's the blood, sweat, tears of multiple generations that go into that, and they're not financially sophisticated. So they really appreciate our advice for building this. But we do need to build liquidity into a portfolio. We're not the Harvard endowment, another Yale endowment, where we can have a 500-year horizon and we only need 5% of the portfolio liquid at any point in time. We do need to build in liquidity so that if our clients come to us and request us to sell 20, 30, 40% of the portfolio to meet some unexpected need, we need to have those liquidity sleeves built in. But we build it at the portfolio level. And so a certain portion of the fund being illiquid because of the illiquidity premium is absolutely appropriate. So there are a few benefits in building your more diversified portfolio this way. The first is what we've already talked about, is the evolution of private market liquidity. So once upon a time, to get access to any of those 5 sub-sleeves that I was talking about, you need a minimum ticket size of $10 million US. You need to lock money up for at least 10 years. You need to be a qualified purchaser in the US. You need to have at least $5 million of war of the entity that you're in, just for the entity. So it's at a per entity level. And so that immediately excluded 99% of the population. And so, institutions like Gale have been able to compound money at 14% per annum for the last 50 or 60 years because they got unfair advantages of getting access to these markets. It's not the case anymore. Everyone in the room here is evidence of the fact that, the average investor, someone that doesn't have $20 billion to invest, can have that. Some of you might, and if you do, please come and talk to me after this. But the playing field has now been leveled with technology. The second is capital deployment versus SAA. And so this is quite an important point. We have a strategic asset allocation that we run for clients, depending on whether they need an income portfolio, a balanced portfolio, or a growth portfolio, right? The SAA is the long-term, guardrails about how much we're doing into particular asset classes. When you only have access to closed-ended lockup funds, it's quite difficult to get a particular SAA framework in place. So this is an evergreen structure, which, you can access VC and PE and all of the asset classes in an evergreen structure. It allows us to a little bit easier meet those target kind of allocations. So if I was to think about balanced portfolios, about 10% to private equity and venture capital, 10% to private debt, private credit, 10% into infrastructure and property, and then hedge funds and zero beta alts make up the remainder. It's not to say that we only prefer semi-liquid structures over closed-ended structures. It's just understanding the benefits and costs of both of those. So IRR versus time-weighted return. This is something that I'm surprised about how many people I meet in finance that don't understand the difference with this, right? Yes, a little bit mathematical, and I've got an example here. And all of these kind of slides and information comes from an internal document we happily share with you guys if you want afterwards. But an IRR and a time-weighted return is not the same thing. So when you put $100 into public markets, you're getting $100 at work immediately, and that $100 starts to compound. When you're putting money into private markets, there's a drawdown structure, there's a capital call structure. Typically, with a typical PE or VC fund, it's 20% run call down over the first 5 years. You've got the investment period and then the harvesting period. So you need to expect a higher IRR than you would expect from your public market exposure. And you can't compare the two. So at the top here, I've got an evergreen annualized return, that I've got a closed-ended IRR. I'm not explaining this to kind of discourage anybody from locking money up. It's just you need to understand the return hurdles that you should expect to be compensated for that bit of liquidity. So on average, as you can see, it's about a 40% discount to an IRR to equate it to a time-weighted return to end up with the same multiple on invested capital. A typical VC fund, you're probably expecting about 25 to 30% per annum as an IRR over a 10 to 15-year time horizon. If you just do the mathematics of 1.30 to the power of 15, it's a lot more than a 6x MOIC, right? That is the difference between IRR and time-weighted return. So I encourage you, when you're looking at opportunities out there, just be aware of the differences, because they're not apples and apples. It's apples and oranges. We published a paper on this. I'm working on a second paper at the moment. And again, we can make this paper available to, it was published in the Journal of Multidisciplinary Research. And I published it with Tamar, one of my CFA colleagues. And we went through each of the individual alternative investment asset classes and its job in private wealth, modern private wealth portfolios. And I think that we're at 40%. We tend to just do what we say we're going to do. And a lot of groups out there will kind of say that they're doing 10 or 15 or 20%. A lot of the advisors in those groups are actually doing 40 or 50% if you look underneath the hood. And it's the definitions that really matter. And when you take property out of that sleeve, all of a sudden that's when the alts kind of drops down to 10, 15, 20%. That's all I really had to run through. There's so much we could talk about. We put out a lot of video on this. We talk publicly about it. it always surprises me that we continue to need to educate the market on the benefits of alts, because in my world, this is just par for the course. And this is just come to work stuff we've been doing this.